A very good morning, good afternoon, and good evening to all. Myself, Vaibhav. In today's session of Visual JForex, we will be working with the indicator named RVI, which stands for the Relative Vigor Index. This is the second session, and in today's session, I will be explaining to you the execution part of the algorithm for the buy side for the buy trade. So let us now head to the Visual JForex board, which has been developed by the Dukascopy Bank SA. In the last session, in the first part of this series, I had completed the structure so far, which includes this default instrument subscription where the instrument of choice is Euro USD. Afterwards, the position amount was defined at 0. These RVI blocks of the hourly candle periods have been added with the default time period of 10 to look at the price action data, and also to make sure that there is enough of momentum on the side of the trade. On the bullish side, if you are looking for the buy trade, and the momentum should be bearish if you are looking for the sell trade, we will be taking the help of this get historical candle of the hourly candle period. And then to make the entry precise, to pinpoint the entry point, these 10-second candles will help. And here this condition has been added of the 20 pips, so this calculation was done. Now we have to resume from where we left, and I will give you a brief refresher of sort of the idea behind the execution of the trade. For any buy trade to take place, we want the momentum to be shifting on the bullish side from being sideways or bearish. So it should be a new start, a new beginning for the upward journey for the underlying instrument, and that's where we want to get involved. And to make sure that is the case, we are relying on this indicator formation of the RVI. We are placing the conditions which are kind of simple to understand and equally simple to execute. We simply need the RVI value to have recently crossed over the zero line. Zero line is a critical marker. The output of the RVI above zero is considered favorable for the bullish momentum for bullish trades. And if the RVI value is zero below zero, that is indicative of the bearishness in the underlying instrument. So that's what we are going to rely on. We will need the last hourly RVI output to be above zero, and it should also be above the signal line. So that will mean the momentum is on the bullish side. And to make sure that this is the fresh start, a new beginning, we are also placing the condition that 6 hours back, the RVI value should be below zero, should have been below zero, and also the crossover need to be have been on the bearish side. So we will need the RVI output to have been below zero as well as below signal line. And now 6 hours later, it has shifted the momentum. Now the RVI output value is above zero as well as above the signal line. So that will be a indication of the change of momentum in the underlying instrument, and that is the time when we want to get involved. And to make sure there is substantial momentum, we are also taking into consideration the price difference between the last hourly candle close and the hourly candle which closed 4 hours back. So we will be looking at the time interval of 4 hours in between these two hourly candles, and what we need is last hourly candle close will need to be greater than at least 20 pips, more than 20 pips compared to the candle close which happened 4 hours back. So suppose if it is this, we will be taking into consideration the interval of 4 hours, 1, 2, 3, and 4. So this is the hourly candle. We will compare with the closing value of this, and as you can see, this time around there is indeed this difference of more than 20 pips. And also I think we will have to look at the RVI output, and it looks like what time it is 12 o'clock, and RVI output at 12 is still below zero. So I think it might not happen here, but somewhere here we will have the RVI output above zero. And if we have this prior crossover in the required formation where we need the RVI output to have been below zero as well as signal line, the trade execution will happen. So that's the idea behind these algorithm. Now let's turn to the execution part. We have to get the calculation done for figuring out the actual difference, which will then be compared to this predetermined value of 20 pips. And afterwards we will simply add the comparative structure using the logical blocks of if else to make sure that RVI output values are as per our requirement. So first thing first, we get the calculations done. For that we are going to rely on the calculation expression block, and let me now calculate the actual difference between the closing value of candle 15 and candle 16. Candle 15 close needs to have been greater than candle 16 close by at least 20 pips. So not this way. We go to the auto created variable where we have this candle 15 candle close, and I will deduct candle 16 candle close from it. Okay, so this is going to be a1 minus a2. All right, this will be hourly actual difference. Okay, now let us define the conditions, and for that we are going to need the logical components, and multiple action block will also be needed on the lower side. Okay, now let us begin with the formation involving the RVI. Last hourly RVI output will need to be greater than the last hour signal line output. Okay, so here first input greater than second input, first input greater than second input. Okay, then we will consider the output value 6 hours back, where the formation needs to have remained in a inverted manner. We will need the RVI output to have been below signal line, so first input less than second input. Now we compare the RVI output to the zero line. The last hour's RVI output will need to be greater than 0. So first input greater than second input, whereas the output value of 6 hours back needs to have been below 0. Okay, so now we have this RVI formation in place, and I will add further blocks to define the price action, and for that we have to compare actual difference between the candle 15 candle close and candle 16 candle close, and that will then be compared to the predetermined value. Okay, so we have, so here first input less than second input, and after that this should be first input greater than second input. So we have determined these factors which need to be in place for any buy trade to execute. Now coming to the precise point where the trade execution will happen, we will go for a market execution, and for that we will be comparing the closing values of the candle 15 and candle 17 and candle 18. So candle 15 candle close will act as a starting point for the trade. As and when the price starts to rise above the candle 15 candle close, the order will be placed. To define that, we simply need candle 17 candle close to happen above candle 15 candle close, whereas candle 18 candle close was below candle 15 candle close. Okay, these two candles carry the shift values of 1 and 2 respectively. So here I am going to take candle 15 and compare it to candle 17 candle close and candle 18 first input greater than second input, and after this we bring in the trade command block, open at market. This is kind of simple. We need only this first input to have been less than second input, and I will place these blocks on the lower side, and afterwards we define the input parameters for the trade command block. Default instrument remains as it is. Trade amount I will change to 0.1 million. Slippage, I think 2 pips is good enough. Now comes this stop loss and take profit formation question. There are two different ways you can go and deal with this problem. One way it is to set predetermined stop loss target price depending on your assessment of the volatility in underlying instrument. Usually for Euro USD on most days the average range is in between 40 pips to 50 pips. So depending on that, if you are dealing with the price formation which involves roughly 6 hours of time span, I think you can take 15 pips, 20 pips as your stop loss and target price zone. So with that kind of setup, if you are going with the static formation, I think even the combination of 15 pips and 30 pips should serve the purpose. Other way to deal with it is make the stop loss and target price dynamic, and for that you can simply rely on the recent volatility, and depending on that you can set the condition for whatever is the actual difference. Say for example, we had already carried out the calculation to determine the difference between these hourly candle with the time interval of 4 hours. You can even take that into consideration, and simply in a desirable ratio you can set the stop loss and take profit conditions. But to keep things simple this time around, I will not really make the stop loss and target price dynamic. Rather than that, we will go with a static formation of 15 pips and 30 pips. But if you feel like you want to make it dynamic, then I think if you want to, you can refer to the earlier sessions, and on many occasions I have carried out the execution part for making the stop loss and target price dynamic using these historical data, where we take into consideration the actual difference between two historical candles, and then to make it into integer data type we have to get it multiplied with a desirable factor of 10 raised to the power 4, as the euro USD has the values up to the decimal point 4, up to the 4 decimal points. So that conversion also needs to be done, so you can refer to the earlier videos. So with this we are going to stop here, and if you join it here, we have this algorithm complete as far as buy side is concerned. And if we check for this trade iteration flow, it is going till the very end. So we have this formation. Okay, so that's it from my side for the day. I hope you understood the logical as well as the execution part of this algorithm, and do try it out on your own. For next session, we will be dealing with the sell side of the equation. I will be explaining to you how we can define the conditions for the execution of the sell trade. So that's it for the day. Thank you all for joining in. See you next time. Till then, goodbye.